Hi, my name is Marc Chapman. I run the HI Principia European Fund. Now, looking into 2017, essentially the market was characterized by quite a lot of momentum. Earnings surprises came through because the Eurozone was stronger than expected. And also synchronized global expansion meant that the environment was quite dynamic for equities. In terms of the overall portfolio, this meant that hedging costs were quite substantial during 2017. As you know, we target a return which is differentiated from the index and also has a low correlation with the overall market. Now, in terms of individual hedging, the decline in volatility obviously had an impact on option pricing, and also the level of the European markets affected individual shorts and futures. Despite that, the return was positive based on the fact that there was good alpha in the long book. This came from the technology and healthcare space, as well as individual industrial companies where we found names where earnings could be clearly exceeded. Looking at 2018, given that the possibility for earnings surprises is potentially lower, and also given the fact that central banks may be tapering, we think the environment later on in the year could become more volatile. In which case, we think that the strategy of the fund should perform well during that sort of environment. Essentially, a flat, volatile environment has historically been a good one for the overall strategy. The strategy is underpinned by fundamentally a lot of company meetings, but also trading activity. Obviously, active trading works better in a more volatile, stable environment than it does in a trending one. Therefore, we would say that the overall environment being flattish and volatile could work well for the overall strategy during 2018. The main thrust of the approach remains individual stock picking. We meet between 10 and 15 companies per week of all sizes in all different countries in Europe, and we look fundamentally for those names which can outperform the consensus expectations for individual stock reasons, not for sector reasons. They're obviously difficult to find and it requires a lot of bottom-up stock-specific work. But that's the thrust of the approach which derives the long book. Overall, the upside to our longs we think is still between 30 and 35% on a 2-year basis. So therefore, assuming a reasonable return on the short side, we think the midterm return target of between 7 and 8% with a constrained volatility is still achievable in the current market circumstance. Thank you.